Hello, everyone, and welcome to the Nasdaq Dorsey Wright podcast. For the last podcast that we're doing here in the month of March, the time we're recording here, it's going to be March 31st. This podcast is going to be coming out on Friday, April 1st, which is going to be the new release time for the Nasdaq Dorsey Wright podcast series moving forward. My name is Ian Saunders, and joining us here as well today is Jamie West. Jamie, it's great to be back in the office, and great to actually be doing this, sitting across the table from each other, face to face. Something we haven't done for over 2 years at this point. We're getting more people back in the office over the course of the past few weeks here, and opening things up to get back in the normal swing of things from a media standpoint. So no shortage of movement that we're seeing coming into the market movement throughout the course of the past week. Seen some more improvement from the domestic equity side of things, but seen a fair amount of movement on the rate side of things as well. And that's what we're going to touch on for the majority of the time today, looking specifically at some of the various inversions from the yield curve. So Jamie handles the majority of the fixed income kind of research on our end. So he's no better person to have come in and give us some insight than that. So, Jamie, great to have you here. And I guess the first question is, as we were kind of talking about, a lot of people might not necessarily know exactly what we mean when we say like an inverting yield curve.
Yeah, thanks, Ian. So yield curve inversion is basically when we see short-term rates move above long-term rates. In kind of a normal environment, as you go out on the yield curve, it slopes upwards. So, longer term maturities, bonds that are further out in the time till they mature are going to have a higher yield than shorter term bonds. Now, when they invert, that kind of is flipped on its head, and we have shorter term rates higher than longer term rates. And one of the key relationships that people keep an eye on is the 2-year to 10-year relationship. And that relationship briefly inverted on Tuesday, where we saw the 2-year move above the 10-year. It didn't stay that way. It closed with the 10-year back above the 2 in a normal state. But, that has prompted some discussion about, potential recession as, an inverted yield curve, especially the 2 to 10, is often cited as an indicator of recession. Theoretically, interest rates reflect expectations. So if the 10-year, let's say, is yielding 2.4%, that means that there's an expectation, theoretically, that short-term rates will average about 2.4% over the next 10 years. So, if we accept that theory to be true, then when short-term rates like the 2-year are higher than a longer-term rate like the 10, that means the expectation is for rates to be higher over the short term and then kind of come down. And when do we typically see, rates come down? It's when the Fed lowers them in response usually to an economic slowdown or a recession. One potential scenario being that the Fed raises rates in the near term, perhaps to combat inflation like we see currently, but they do it too quickly, and that brings about a recession. And then ultimately, in the medium term, they are forced to reverse course and lower rates. And that's how you can kind of see these kinks or inversions in the yield curve.
Great. Yeah. Thank you, Jamie. And I mean, looking at looking at some of the charts that we have on the site, I mean, you look at that US 2-year Treasury yield index, which for those that are following along on the platform, the ticker is going to be US2 YR, so US and the number 2 and then YR. I mean, you saw that break a triple top with movement over the past couple of weeks at 165, and then continue to climb to ultimately top out at a 245 chart level before reversing back down into a column of O's with movement yesterday. And then as we've just kind of talking about as well, I mean, you've seen a lot of improvement, obviously, from the 10-year yield index, TNX, for those following along on the platform, has given 3 consecutive buy signals there on that default chart after passing a test of its bullish support line or positive trend line, and then topped out at an ultimate level of 2,500 or 250, sorry, and then continued to turn back around down to a current chart position around 23.25. So I mean, looking at it from a closing price standpoint, these haven't necessarily inverted, and just looking at closing prices, but they did on an intraday basis. So kind of flash some of those headlines like we were touching on there. But when these do invert, I mean, whether you're looking at a closing price, whether you're looking at it or like an intraday, I mean, is that, I guess for the listeners, does that necessarily mean, okay, recession definitely going to come, or does that mean it's coming down the road, or next week, or next month, or what do we kind of see on that front?
Well, obviously, I don't think any indicator is a foolproof thing. But I will say, the inversion of the 210 has preceded pretty much every recession since the 1970s. As you mentioned, they did invert intraday. They did not close on it, inverted. So the 10 is back above the 2, at least, through close yesterday. But the spread, between them sits at, less than 5 basis points, which means, we could see them invert at pretty much any time. And then, maybe even uninvert again. However, just because that they preceded these, a number of recessions doesn't mean that it has to happen. It also doesn't mean that the 2 to 10 is necessarily the best indicator out there. A lot of analysts and economists say that they prefer the 3 month to 10 month spread, 3 months to 10 year spread. Obviously, the 3 months being much closer to the short end of the curve, where the Fed has a lot more control. And so you're getting more of a very short-term comparison, with an intermediate to longer term with the 10-year. And so a lot of analysts have expressed a preference for that as a better, indication of a potential recession. And as it stands now, that relationship is nowhere near inverting. The 10-year is still about, 180 basis points above the 3 month. Previously, I want to say like 2019, we saw this get, much closer. And, there was while we've seen a flattening of the yield curve in like the 2 to 10 range, and a very pronounced steepening in the, let's say 2 month to 2 year range, we saw a much flatter curve around 2019, where there just wasn't a whole lot of room from, 3 months all the way out to maybe 10 years. So not quite the same scenario, but, I've digressed a bit. The point being that this is not the only potential indicator of recession on the yield curve. One that a lot of professionals prefer is the 3 months to 10 year, and that is not anywhere close to inverting. Other observers have contended that, more than any single relationship, what we should do is kind of look at relationships across the yield curve and measure the portion of those that are inverted, with the idea being that historically recessions have only come when we've seen 70, 80, 90% of the yield curve inverted. Now, depending on how many relationships you want to measure on the yield curve, it runs all the way from 1 month out to 30 years. So, maybe looking for an inversion in the 1 month to 30, maybe you're unlikely to get that, and you don't want to, go from the very shortest maturity to the longest. Maybe you want to start at the 1 year and go to the 20. But depending on how you slice it, somewhere between 10 to 15% of the yield curve is currently inverted. So nowhere near those very high levels of inversion that we've seen in prior recessions or preceding prior recessions. And another thing to note, as you said, we saw this very brief inversion, which has returned to a normal state. Typically, we've only seen recessions come after the yield curve, or in this case, since we're talking about the 210, since we've seen that relationship invert for an extended period of time. The fact that we saw this, kind of quick inversion and a reversal, probably not very meaningful on its own. I mean, theoretically, you could have had hundreds of these inversions, and looking at daily data, you wouldn't even know that they happened because they closed back in a normal state. Now, obviously, there's going to be some evidence that you got very close to an inversion. It's not as though these things move 100 basis points a day, but theoretically, an intraday cross, looking back to analyze historical data, if you're using daily data like a lot of people do, you wouldn't even pick up on this kind of move. So, I don't think this is necessarily particularly meaningful. As I said, we've typically seen recessions come after extended periods of inversion. And then, beyond that, even when a recession has come, it's typically been 12 to 15 months or more after the yield curve initially inverted. So, a lot of things here are kind of saying, well, okay, yeah, we did see this inversion, but, maybe it's not as big a deal as, some of the news articles that you may be reading on the internet may make it out to be. And, there is no denying the fact that, inversion of the 210 has preceded pretty much every recession that we've had for the last 70 years or 50 years or so. But we also can't rule out the possibility that this may just be incidental. We saw the 210 spread invert briefly in 2019, and then there was a recession in 2020. So, technically the 210 inverted before the recession. So, if you were saying that it predicts a recession every time, technically you wouldn't be wrong. But I think a strong argument can be made that the 2020 recession really had nothing to do with underlying economic fundamentals that the 210 is supposed to reflect. So, saying that the yield curve predicted the 2020 recession, I think we may be giving a little too much credit. Now, of course, there's a possibility that, we would have had a recession anyway, even if COVID didn't happen. I mean, that's the thing about economics. It doesn't happen in a lab. You can't go out there and test, tweak one thing and see what happens. But, saying that the 210 has a perfect track record, I think you'd have to put an asterisk next to 2020. So, overall, I think there are some valid reasons why we should be concerned about the flattening of the yield curve. It definitely, I don't think that maybe the expectations theory isn't 100% correct, but it definitely reflects some economic and fundamental realities. So when we do see this, kind of flattening of the yield curve and these inversions, I think it definitely does reflect some concern on the part of investors about where the economy is headed. And, in a lot of cases, we see that, kind of things become a self-fulfilling prophecy. People think there's going to be economic trouble, so they slow down on hiring or building or investing, and boom, you do have a recession. So I don't think you can ignore that. However, given the historical evidence, I don't think there's a lot of reason to be overly worried yet. As we've discussed, the 210 hasn't even inverted yet on a closing price basis. The 310, 3 month to 10 year, which a lot of people prefer, remains with a very wide spread. And then if we're looking at the percentage method, again, not a big percentage of the yield curve is inverted. It's really that kind of grouping in the 2 year to 10 year spread. And then right now the 20 is over the 30. So you get kind of this, sharp up from 1 month to 2 years, and then kind of a flat move across, and then another up move. So not kind of this, the very flat yield curve that we saw, previously. So, overall, I wouldn't dismiss all of the, the concerns about inversion and what it means. But, a lot of these, I would call them maybe Chicken Little articles that are making their way into the media are probably, more concerned with maybe getting ads getting clicks for ad revenue than absolutely representing the truth behind what this means.
Yeah, I think that makes a lot of sense, and I think that aspect that you touched on there, looking at the combining kind of multiple multiple yield curves into one kind of almost like a sentiment kind of percentage based deal. I mean, it makes a lot of sense. You're looking at from, as we like to say a lot, of weight of the evidence aspect, right? I mean, weight of the evidence, yeah, you might see one indicator flip, you might see one chart give a sell signal, but I mean, you're looking at the overall weight of the evidence versus just focusing on one specific thing. And I think that certainly carries over to this kind of conversation as well. I mean, and when carrying it over and looking at the weight of the evidence for the broader domestic equity space right now, I mean, not really seeing that much, not really seeing that kind of potential inversion had that much of a negative effect, at least at the time of this recording here. I mean, we're seeing a lot of market turbulence throughout the first 3 months of the year, a lot of declines, looking at the first kind of correction territory for most of the major broader indices in well over a year. But now you're seeing some of the participation swing back to the upside. You're seeing some of the bullish percent and positive trend charts reverse higher. So it is good to see those signs kind of moving in conjunction with one another as we look out at the broader state of the domestic equity market and looking toward the second quarter of 2022. So I mean, it's hard to believe the first 3 months are already over, but definitely be looking to see if this positive participation can continue as we head into the month of April. So with that, I think that wraps up most of what we were looking to cover here. Jamie, wonderful to have you on, and wonderful to be sitting across and talking to you in person rather than just necessarily over the webcam here.